Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly edition of the Economic Review for the week ending February 10th, 2023. So yeah, time flies. So look at this week's markets at the close on Thursday to get started. Negative for bonds, for equities, so a bit of a reversal from the moves that we saw since the beginning of the year that are pretty apparent here. So interest rates a bit higher because the market is starting to, maybe hear what the message from the central banks that rate hikes could continue. At least rate cuts maybe are not as close as the market was expecting. Also seeing the data coming out that is supporting the scenario that we could see some more rate hikes by the end of 2022. It's starting to be pretty apparent that this is a scenario that we need to look at least. So rates up, stock market a little bit lower on the week, and of course the Nasdaq was the main beneficiary of the recent move, so it's gaining a bit more, losing a bit more steam here. Also, price of oil higher, USD CAD, Euro lower versus the CAD and the Euro lower versus the USD, and the price of gold under pressure slightly this week. So Bank of Canada. So we had the pleasure of welcoming Mr. Tiff Macklem in Quebec City this week. I was part of the organization, and I had the chance to ask the questions to Mr. Macklem from the audience. And the message was pretty clear that they're taking a pause right now, but the pause is conditional on the incoming data, and if the labor market remains too strong, that might push them to hike more. If wage growth still stays stubborn, let's say, they could do more hikes. If inflation is more stubborn, they could do more hikes. So that was the message. So yes, they are recognizing that there's going to be an impact on the economy here, but the target here is inflation. So that was the message, and that brings us to the labor market report that we had today on Friday. Canada's labor market is red hot, so it does add some pressure on the Bank of Canada. Likely we'll see a pause for the March decision. This is still our base case scenario. Maybe we'll see one for the next meeting after, but if we do continue to see a strong labor market leading to wage pressures, now wages are slowing down, but still at very elevated level. It was at 4.7% year over year last month. Now it's 4.5%, so that's still pretty high. That might push them into getting out of this pause and continuing with some hikes. So this is the bad news. The good news is that, well, if the labor market is this strong, maybe we'll avoid the recession. So the recession scenario, I would say, is taking a hit right now. It's getting less and less likely. We need to recognize that. But if the economy remains too vigorous, that pushes inflation. So that means maybe more hikes. So pick your poison here. But it was a surprise this morning. Consensus was for 15,000 jobs added. We got 150, so that was 10 times that. So this is the Canadian situation. Of course, last week, if you remember, I recorded the reviews before the numbers were out in the US. Well, numbers were almost in line with Canada. So 500,000 jobs added in the US. That was twice consensus. In Canada, it was 10 times. The US was twice. But on the right, you see the number of jobs that are open but not filled. It's starting to take back up again. So what we're seeing is that in the services sectors, now people are coming back. So it's easier to hire. So that maybe that explains why there's a bit less wage pressure, because now they don't have to outbid the next firm as much as before to hire people. But there's some labor hoarding going on that should support economic growth, and that should support inflationary pressure down the road. And that brings us to the used car market here. So prices are starting to rise again for the used car market. And remember that this was one of the first components of inflation that push inflation higher. Used cars, new cars, and the fact that we had underproduction for a few years for new cars means that now the used car market is feeling a bit undersupplied, and we're starting to see prices rise again, which should contribute to inflation too. So the case for rate hikes in H2 of 2023 is starting to get clearer and clearer. So it's not the base case scenario yet, but we are definitely fleshing it out and considering it in our strategies. So important developments here at the beginning of the year, and it could cool down the verve of the market, I would say, pretty quickly if these signals continue to stack up. So what to watch next week in Canada? We'll have the Terranet National Bank Home Price Index. Last month it was 0% year over year, so flat. Likely now we'll go into negative territory, so it's going to be an interesting one to follow. In the US, CPI inflation on Valentine's Day, February 14. We're starting to following it more, report it more here in month over month basis. So 0.5% month over month is very strong. If this is what we get, that's the consensus. Think that, well, if we are about on target, we should see 0.2% month over month. And 0.3 and above means that inflationary pressures remain too strong. So 0.5 is pretty strong. So that's a pace of about 6% annualized. So we'll see what we have next week. That could be another factor that could put the lid on this market rebound a little bit more. Retail sales should come in strong, though the consensus is for 1.6% month over month. So that shows that the economy remains strong. So again, pointing towards diminishing odds of a recession in at least first half of 2023. But the economy is much stronger than we expected. And again, that means that inflation might stay more stubborn. Central banks might have to do some more. So this is not necessarily bullish for markets here. So to follow us, ia.ca/economy. You can subscribe if it's not done. Podcast in your interest. New content every single week. And of course, social media, Twitter, LinkedIn. You can follow me there. So that wraps it up for the week. Always a pleasure to serve you, and I'll be back again next week.